The evidence is overwhelming that the longer investors play the game, the more likely they are to lose. SPIVA research, for instance, highlights that over a 1-year period for US large cap stock pickers, it's almost a coin toss whether they can beat the market or not. But only around 15% of investors beat the S&P 500 over a 5-year period. And that number drops even further, below 10% if you extend the investment horizon to 10 years. So arguably, investors' long-term performance follows a power law distribution, where only a very small number of investors can beat the market, but they beat the market quite handily, and the vast majority, 95% or more, will underperform the market. But nonetheless, investors use plenty of tricks in their attempts to beat the overall performance of the stock market, and leveraged ETFs as well as short ETFs seem to be particularly popular tools among investors. But in this video, I will outline that both leveraged and short ETFs have some very significant risks and drawbacks that both short and long-term investors are often unaware of. So without further ado, let's get started. Hi there, my name is René Salman, and in my last video, I already discussed a common misconception about ETFs. And in this video, I want to highlight another misunderstanding that I think can be incredibly costly, especially if you aren't aware of the underlying process of ETFs and thus don't know what you are doing. What's important to understand is that not all ETFs attempt to match the performance of a broad market index. For example, an instrument that attempts to multiply or boost the performance of an underlying index with the help of debt are leveraged ETFs. And I believe that the average retail investor totally misunderstands how the underlying compounding rate of these kinds of ETFs can both positively but also negatively impact returns depending on the market condition. And they totally underestimate the risk associated with these financial instruments. So, for starters, ETFs are compounding daily, and what makes compounding so tricky is that over a period longer than 1 day, returns will be greater or less than the sum of the individual daily returns, which is often overlooked and misunderstood by investors. So to start with the very basic and simple example, an investment that compounds at say 1% per day. This is just a hypothetical example, of course, will not end an 11-day period with a return of 11%. No, the compounded return will be greater than 11%. So our first general rule is that the compounding effect can positively enhance returns in upward markets and may lead to larger returns than you may expect. And similarly, returns are not what you may expect in declining markets. If an index, for example, decreases by 2% each day over again, an 11-day period, you may expect the index to be down 22%, but in reality, the cumulative return is less than 22%. It is 19.9%. And if a market trends sideways and is very volatile, the final result may also be completely different than you may expect. If, for example, an index increases by 2% and then decreases by 2% the next day and continues to follow the same pattern for 11 days, you may expect the index to be up 2% after that 11-day period. However, the cumulative return is less. It is 1.8%. And as I will show you in a second, when we get to the point that I'm actually trying to make in this video, once you add leverage, things get even more complicated as the effect of compounding will be further amplified when daily returns are leveraged. A second rule that most retail investors are not aware of is that for periods longer than 1 day, daily compounded returns of leveraged products may not be equal to an unleveraged return, or the benchmark index, multiplied by the leverage factor. What I will do here is I would like to reference what Terry Smith highlighted in his book Investing for Growth by showing his readers the following table. What you can see here are highly volatile index returns over a 3-day period. You can see the daily returns as well as the cumulative change of a regular unleveraged index, as well as the daily returns and the cumulative change of a 2x leveraged ETF. And as you can see, the total return of the leveraged ETF is not equal to the return of the unleveraged ETF multiplied by the leverage factor of 2. Now the unleveraged ETF ends the period up around 3%, and so you might expect the return of the 2x leveraged ETF to be 6%. But quite the opposite is the case, as the leveraged ETF ends this 3-day period down more than 15%. Generally speaking, the average returns on leveraged ETFs during volatile periods tend to underperform the multiplier. And that's especially true for periods with some very sharp declines occurring in that period. To provide another example here. Earlier we used the example of an index that increases by 2% and then decreases by 2% the next day for 11 days. After the 11-day period, an index investor is up 1.8%. If you now invest in the same index but at a leverage factor of 3, you do not end the period up 5.4%, so 1.8 multiplied by 3, but only 4.1%. Now, of course, leverage works both ways, and in a different, less volatile scenario, upside returns may be amplified and provide big and quick profits, as this example here shows. A similar, weird, and somewhat hard to understand dynamic can, by the way, also be observed in inverse ETFs, also known as short ETFs. A short ETF is a type of ETF which aims to rise in value if the underlying index falls in value. So for example, if the S&P decreased by 2% in value, an inverse ETF which tracks the S&P will increase 2% in value and vice versa. But again, due to the daily compounding mechanism of ETFs, there are situations during which the underlying index goes down and an investor who invests in a short ETF loses money as well. This is also something that Terry Smith shows in his book by including the following example. Over a 4-day period that was very volatile on the downside, but during which the index ended up break even, a short ETF would end the week with a 70% loss. Now imagine what a product like a leveraged short ETF would do. Let me know in the comments down below if you can figure out the result for such a product. And I bet few retail investors actually understand this, and this is why Terry Smith concludes in his book, the moral of this is that these sorts of ETFs are really day trading tools. If they are held for more than 1 day, they will begin to diverge from the performance of the underlying index or asset class. However, it would not be surprising if in many cases they were being used inappropriately, as if they are index funds. Now, if you want to become a better investor, I think you are only halfway there. To learn more about ETFs, I think you should watch the following video next to become familiar with another major ETF misunderstanding. Take care.